Hello friends, today we are going to begin a very interesting topic called behavioral finance. Before we start, let me ask you a simple question. Suppose you have 1000 rupees in your pocket. Would every one of you spend that money in exactly the same way? No chance. Some may say they would save it. Some may spend it. Others may invest it. The amount of money is the same, but people's decisions are different. Why? Different persons have different ideas on spending and saving. They decide as they prefer. That is the question behavioral finance tries to answer. Behavioral finance studies the human side of financial decisions. It tells us that finance is not only about numbers, calculations and profits. It is also about how people think, feel and behave. If we understand our own behavior, we can make wiser financial decisions and avoid costly mistakes. Have you ever bought something just because your friends bought it? Maybe. If you have done so, that is exactly the kind of behavior we will study in this class. Now, let us understand what behavioral finance actually means. Look at the definition on the slide. Behavioral finance is the study of how psychological, emotional, and social factors influence the financial decisions of individuals and investors. Let us compare this with traditional finance. Traditional finance assumes that people are always rational. That means people think logically, always act in their own best interest, choose the option that gives maximum benefit. But behavioral finance says something different. It says people are human. Emotions influence decisions. We sometimes make irrational choices. Friends, family and society also influence our financial behavior. Have you ever purchased something simply because it was on a discount, even though you didn't really need it? If so, that decision may not be completely logical. It is influenced by emotions and marketing. Behavioral finance helps us understand why such decisions happen. Behavioral finance bridges finance and human psychology to explain real-world financial decisions. If human behavior affects our decisions, why is it important to study it? Let us see. This slide explains why behavioral finance is important in our daily lives. It affects the way we save money, spend money, borrow money, and invest money. It also helps us understand why financial markets sometimes behave unexpectedly. For example, during a stock market boom, many people invest simply because everyone else is investing. Later, when prices fall, many panic and sell. Behavioral finance explains why such situations occur. It also helps us avoid costly financial mistakes, make better financial plans, become more aware of our own emotions and thinking. Which is easier, controlling the market or controlling your own behavior? It is better to control our own behavior. Why? We cannot control market prices, but we can control our financial decisions. That's why understanding human behavior is the key to better financial decisions. Better understanding of behavior leads to smarter choices and a stronger financial future. So, what is the central idea behind behavioral finance? The next slide explains it beautifully. Look carefully at the quotation on this slide. It says, "We are not always rational, but we are always human." This is the heart of behavioral finance. Our financial decisions are influenced by many factors. The slide mentions 5 important influences. Our thinking. Sometimes our brain processes information quickly and makes shortcuts. Our emotions, feelings like fear, excitement, and regret all influence our decisions. For example, fear may stop someone from investing even when a good opportunity exists. Another influence is our social environment. Friends, family, social media, and society influence our financial choices. Many people buy products simply because others are buying them. Our own past experiences. A person who once lost money in the stock market may hesitate to invest again. Our goals and expectations. Future plans also affect today's financial decisions. For example, a student saving money for higher education will spend differently from someone saving for a holiday. What do you think? Can two people with the same income make completely different financial decisions? Of course, yes. Because every person's experiences, emotions, and goals are different. Behavioral finance focuses on why people make financial decisions, not just what decisions they make. Understanding the human mind helps us make better financial choices. So far, we have understood what behavioral finance is and why it is important. Now, let us look at its main features. The first feature is that behavioral finance follows an interdisciplinary approach. This means it does not depend only on finance. It combines knowledge from psychology, economics, and sociology to understand financial decisions. The second feature is realistic assumptions. Traditional finance assumes that people are perfectly rational. Behavioral finance accepts that people have emotions, make mistakes, and sometimes take irrational decisions. The third feature is practical relevance. It explains what actually happens in the real world rather than what should happen according to theory. The fourth feature is its dynamic nature. Human behavior changes with time, situations, and emotions. Therefore, financial decisions also change. Finally, behavioral finance focuses on better decision making. By understanding our own behavior, we become more aware of our mistakes and make wiser financial decisions. In short, behavioral finance understands human behavior, improves decision quality, gives a more realistic view of markets, leads to better financial outcomes. These are the practical benefits of behavioral finance. Dear friends, do you think that the same person will make the same financial decision when he is happy and when he is worried? Probably not. Why? Our emotions influence our decisions. When human emotions change, financial decisions also change. Behavioral finance helps us understand people as they are, not as theory assumes them to be. Now that we know its features, let us see where behavioral finance is actually applied. This slide shows that behavioral finance is useful in many areas of our financial life. The first area is personal finance. It helps us make better decisions about saving, spending, budgeting, and borrowing. For example, saving money regularly instead of making unnecessary purchases. The second area is investing. It helps investors avoid common mistakes and make long-term investment decisions instead of acting emotionally. The third area is financial markets. Behavioral finance helps explain market trends, price bubbles, and investor behavior. The fourth area is financial inclusion. It helps governments and financial institutions encourage people to use banking services and develop healthy saving habits. The fifth area is public policy and regulation. Governments use behavioral insights to design better policies and improve public participation. The sixth area is corporate decisions. Businesses use behavioral finance to improve pricing, marketing, and product design. Finally, it is also used in education and training, where people are taught financial awareness and disciplined decision making. Behavioral finance applies to every financial decision, whether it is personal or professional. So far, we have discussed the theory. Let us now look at some examples from our daily lives. The first example is overconfidence bias. Sometimes people believe they know more than they actually do. For example, some believe that they know everything about the market and they may trade frequently because they think they can always predict the market. The second example is herd behavior. People follow others without proper analysis. For example, buying a particular share simply because everyone else is buying it. The third example is loss aversion. If you lose rupees 50 today and gain rupees 50 on another day, the pain of losing money and happiness of gaining money may not be proportional. You may feel more than proportional pain on losing money. People feel the pain of losing money more strongly than the happiness of gaining the same amount. Because of this, some investors hold loss-making investments for too long. The fourth example is present bias. Many people prefer immediate enjoyment instead of long-term benefits. For example, spending money on a holiday instead of saving for the future. The fifth example is confirmation bias. People prefer information that supports what they already believe. They ignore facts that disagree with their opinions. The sixth example is anchoring bias. People depend too much on the first piece of information they receive. For example, if a product was originally priced at rupees 10,000 and is now offered at rupees 7,000, many people immediately think it is a great bargain without checking whether this 7,000 is actually a fair price. Have you ever bought something because it was advertised as 50% off? If so, that is a good example of how our decisions can be influenced by the way information is presented. Biases are normal because we are human. The important thing is to recognize them, regain control, and make better financial decisions. So far, we have understood what behavioral finance is, where it is applied, and how different behavioral biases influence our decisions. Now, the important question is, What is the benefit of studying behavioral finance? Look at this slide. It clearly shows that behavioral finance helps us make smarter decisions and achieve better financial outcomes. The first benefit is better decision making. When we understand our own behavior, we make more rational and informed financial decisions. The second benefit is improved risk management. People who recognize their emotions are less likely to take unnecessary risks. The third benefit is higher investment success. By understanding behavioral biases such as overconfidence and herd behavior, investors can avoid common mistakes. The fourth benefit is more efficient financial markets. When investors make informed decisions, markets become more stable and efficient. The fifth benefit is better financial products and services. Banks and financial institutions can design products that match people's actual behavior and needs. The sixth benefit is support for public policy and regulation. Governments use behavioral insights to encourage savings, tax compliance, and responsible financial behavior. The seventh benefit is better financial literacy. Behavioral finance helps people understand their own financial habits and improve money management. Finally, it opens new career opportunities in banking, investment, financial planning, research, and policy making. Notice the ideas shown around the brain in the slide. Better decisions, lower risk, smarter investing, financial well-being, market efficiency, stronger future. These are the long-term advantages of understanding behavioral finance. Now I have a question. Which is more important? Earning more money or making better financial decisions with the money you already have? Good financial decisions often create long-term financial success. Always remember, behavioral finance bridges the gap between theory and reality because people are not machines. They are human beings. After studying the entire topic, let us summarize the most important ideas. This slide gives us a quick revision of everything we have learned. The first takeaway is that people are not perfectly rational. Our emotions, experiences, and mental shortcuts influence financial decisions. The second takeaway is that biases are natural but manageable. Every person has behavioral biases. The important thing is to recognize them and reduce their influence. The third point tells us that better behavior leads to better outcomes. Good decisions often result in lower risks, higher returns, and greater financial well-being. The fourth takeaway is that behavioral finance applies everywhere. Whether we are saving money, investing, shopping, borrowing, or planning for the future, our behavior influences our decisions. The final takeaway is that awareness creates an advantage. When we recognize our own thinking patterns, we avoid costly mistakes and make wiser choices. It reminds us to understand human behavior, recognize biases, manage risks, make smarter decisions, and achieve better outcomes. Do you think, can behavioral finance completely remove emotions from financial decisions? No. The objective is not to eliminate human behavior, but to understand it and make better decisions. Read the quotation at the bottom of the slide. The goal is not to eliminate human behavior from finance, but to understand it so we can make wiser choices. This single sentence summarizes the entire topic. Let us conclude today's class. Thank you.